All right, let's dive right into this explainer. Today, we are totally demystifying the stock market. We're going to build a completely panic-free, step-by-step roadmap for your financial future in 2026.
Look, you might be wondering how to even start investing this year without being absolutely paralyzed by the fear of losing your hard-earned cash to a sudden market crash. And honestly, it's a completely valid concern. The news cycle is loud and the markets can swing wildly. But what if I told you that surviving and actually thriving in the market has almost nothing to do with predicting the future and literally everything to do with solid mathematical habits?
So here's our game plan for today. 1. Why we must invest. 2. Setting your safety guardrails. 3. Understanding the market arena. 4. Mastering risk management math. 5. Bull versus bear markets. And finally, 6. Automating your wealth habit. Let's get into it.
Section 1, Why we must invest, which is really our foundation.
According to the folks over at the FLAM Investment Lab, keeping your cash stuffed under a mattress is actually a guaranteed way to lose. Instead of just letting your money sit idle, we have to invest it for 3 very distinct reasons. We need to earn returns on those resources, we need to fund major life goals, and we absolutely have to protect ourselves against an uncertain future. Because if you don't, inflation is simply going to eat away your purchasing power over time.
Now, to actually achieve those goals, Flame lays out 3 golden rules. You need to start early, you need to do it regularly, and you have to think strictly long-term. Why? Well, because time is what allows your principal and your dividends to actually compound. Basically, the sooner you plant the seed, the more heavy lifting time is going to do for you.
But hey, before jumping headfirst into stocks, you really need to know your asset timelines. Short-term options like standard savings accounts or liquid money market funds are completely different beasts from long-term assets like mutual funds, bonds, and stocks. The absolute golden rule here: never ever put money you are going to need next month into the stock market.
Moving on to Section 2, Setting your safety guardrails. Think of this as your financial armor.
According to FinHabits, to prevent yourself from completely panicking when markets inevitably drop, and they will drop, you must first set up an emergency fund equal to exactly 3 times your monthly survival number. This is a non-negotiable first step to protect your mindset.
So let's do the math on that. Calculate your absolute essentials. If your rent, groceries, and minimum debt payments cost you, say, $2,500 a month, multiplying that by 3 means you're setting aside $7,500. Think of it like a financial airbag. It literally prevents you from panic selling your long-term stocks just to keep the lights on during a temporary downturn.
All right, Section 3, Understanding the market arena. These are the walls of our financial house. It is super vital to understand the difference between the primary market and the secondary market. In the primary market, companies offer brand new securities to the public. Think of an IPO, right? And they do this specifically to raise new capital for their business. But the secondary market, that's where everyday investors trade those already issued shares among themselves. Whenever we talk about trading in the stock market, we are almost always talking about this secondary market.
And you know, trading in these secondary markets is incredibly attractive. For starters, it requires way less starting capital compared to something like buying real estate. Plus, it offers near-instant cash liquidation and takes minimal time to manage. But, and this is a big but, notice I said once you learn the basics, because jumping in blind without understanding the rules, that's really just throwing your money away.
Which brings us perfectly to Section 4, Mastering Risk Management Math. This is the roof over our heads.
According to some really great expert analysis from Trading with Rayner, one of the simplest, most effective strategies out there is the portfolio allocation method. Here's how it works. You limit your investment in any single stock to a maximum of 10% of your total capital. It's a beautifully simple rule that means you can never have more than 10 open trades at once. So, if you have a $3,000 account, you never, under any circumstances, buy more than $300 of a single stock. Period.
Now let's compare that 10% allocation with another really powerful concept, the 1% percentage method. The 10% method is fantastic if you're trading straightforward stocks without leverage, but the 1% method is absolutely crucial if you are using leverage, borrowing capital to trade, or if you need a wider stop loss, which is that automatic trigger to sell before a stock drops too far. The golden rule for this one is that if your stop loss triggers, you never lose more than a tiny 1% of your total account balance.
I know. The formula might look a little intimidating at first glance, but you're really just calculating exactly how many shares to buy. You simply divide your 1% risk amount by the difference between your entry price and your designated stop-loss price.
This mathematical check guarantees that even if the trade goes completely sideways on you, your overall portfolio only takes a totally manageable 1% scratch.
And hey, the really great news here is you don't actually have to sit there with a calculator doing this manually every single time. Free online tools like the position size calculator created by Adrian Reed over at Enlightened Stock Trading can crunch these exact numbers for you instantly. You literally just plug in your account size, your entry price, and your stop loss, and it spits out exactly how many shares you should buy. No registration, no downloaded software, just easy math.
Section 5. Bull versus bear markets. This is all about weathering the storm.
Okay, so in a bull market, when prices are happily rising, you can take a much more aggressive stance. You might concentrate your portfolio, allocating up to 20% per stock, which limits you to just 5 open trades. But in a bear market, when everything looks like a sea of red, you play defense. You drop that allocation way down to maybe 5% across up to 20 trades. Why? Because in a bear market, you really need a larger sample size to find those rare, outlier stocks that are actually winning. You're just protecting your capital until the storm passes.
And finally, Section 6. Automating your wealth habit. This is the routine maintenance.
If managing 10 to 20 individual stocks sounds exhausting to you, and honestly, it kind of is, FinHabits offers a brilliant alternative. Ditch individual stock picking entirely. Instead, build a super simple core using diversified ETFs or exchange-traded funds. Buying just one single S&P 500 ETF gives you instant, stress-free ownership of 500 of America's largest companies, all at the exact same time. It's literally like buying the whole haystack instead of obsessively looking for the needle.
And then you supercharge those ETFs with a technique called dollar-cost averaging. This just means you invest a fixed dollar amount automatically, say every 2 weeks, completely ignoring what the market is doing on that particular day. Because your dollar amount is totally fixed, you naturally end up buying more shares when the market dips and things are cheaper, and you buy fewer shares when the market is peaking. It takes all the emotion and all the guesswork right out of the equation.
I think this quote perfectly summarizes our entire explainer today. The best way to start investing in 2026 isn't to predict the market, it's to build a habit the market can't break. Long-term wealth is not about having some magic crystal ball to predict the next crash. It is all about systematic, boring, and repeatable habits that protect your downside while capturing the market's natural upward trajectory over time.
Because action always beats hesitation. So take a minute today, calculate your monthly survival number, multiply it by 3, and set up those safety guardrails. Really ask yourself right now, are you relying on luck or are you building systematic habits? 2026 is arriving fast. Is your wealth going to be ready for it?